Good afternoon, High 10 George Realty. You hear all the people in the background. We're having a beautiful luncheon provided by Chris Haun. He's going to be addressing right now the VA loans. So we'll get started. Thank you for attending, and we're ready to go. All right, I'm going to let Chris Haun take over the driving.
Thank you so much, Michelle.
Oh, thank you.
Oh, you're very well.
Okay, we're going to get started, everybody. Okay.
Awesome.
And I'm going to go log in. I got finger roll out. I can see you now, Chris.
Can you see me now?
Yes.
All right. Can you see the screen okay, everybody?
Yeah.
Okay, great. Well, thank you guys so much for allowing me to be here, first of all, and then for getting to see your beautiful faces. I haven't seen many of you for a long time, so I'm very happy to get to present to you guys. So let's see. Hopefully this works. Okay, yeah. Looks like I'll just have to slide it down. Okay, it looks like the two slides may kind of be running together, but you do, if you're here at least, you have printouts of everything in color, so you can go through that as well, take notes on it. I spoke to Michelle a couple of weeks ago and said, what could I come to your office and help with that the agents might want to learn about or know? I just didn't want to come in and just be spewing whatever we're offering at the time, or, if it's not going to be helpful. So she did mention right away that knowing more about VA and FHA would be a great topic. There's some things that are very different about these programs than conventional. So, and some great things too. So I want to go over all that with you. Maybe we'll hold questions till the end, unless there's something really just driving you nuts. Stop me and I'll be happy to answer it. But so first, we're going to talk about VA first, just because the other presentation's on its way over, hopefully. Has anyone in this room done a VA loan before or worked with? Oh, great, awesome. So only certain people can get a VA loan, and we're going to, well, overall, what I'm going to cover is who can qualify for a VA loan, what do they need to get a VA loan, what are some of the benefits of VA financing, what does our company do differently with VA, how do we help veterans, what kind of loan amounts can you go to, all these things that you don't need to know verbatim or any of that. I just want you to have a good rounded feel of VA so that when you're talking to veteran clients or you're representing a seller who's getting an offer coming in on a VA loan, what are the differences? How do you deal with that? One of Michelle's main issues that she thought would be a good thing to cover also, that's not in this slide, but I will definitely cover it, is the VA amendatory clause. FHA also has an amendatory clause, so both pretty much work the same way, and we'll get to that during this presentation, but let me get started. So Rate, who's the company that I work for, they used to be known as Guaranteed Rate a few years ago. They changed their name in 2024. They said marketing likes a single word name, and I'm like, wow, that feels really uncomfortable to me, just saying one word. But Rate is the name of the company. We're out of Chicago. Very large company. I think per the rankings recently, we were #2 in the country from Scotsman Guide, which is the main publication for lenders. And they own the White Sox Stadium over there, or have naming rights on it, something like that. But do a lot for veterans. And I'll mention one thing at the very beginning, and it's on one of the flyers that you guys have there. We do waive all lender fees for a veteran. So normally our lender fees are $1,640. For any veteran, it's $0. So right off the bat, you will not have a seller having to go, well, what if I got to pay some non-allowable charges for the veteran? We don't have non-allowable charges. So zero for the client, which is a great benefit for veterans. I don't think they get enough benefits often for what they've done for the country, but that's one that we at least offer. Okay.
When you're talking about, sorry,
Yes.
talking about fees,
Yeah.
like which one, let's say?
So our lender fees, like processing, underwriting, doc, that sort of thing.
Okay.
Ours are normally $16.40, but for veterans, zero. So the origination fee section of their loan estimate will show zero unless they're paying points to buy down the rate, which is great. Okay. All right. This doesn't seem to be flowing just great in regard to the next slide. Let me try this.
Is the reserve considered veteran?
Excuse me?
Reserve?
There's not necessarily reserves required on a VA loan. But those have nothing to do with the non-allowable charges.
No, I mean reserve as a reserve in the Army.
Oh yeah, we'll get to a screen that covers all of that too. Okay. What are you guys seeing there? Okay. So it doesn't seem to be properly sizing it like a PowerPoint, but on the second slide, which is this one, there's 17.9 million vets in the United States. So it's a big group of people. And these loans will, and 1 in 3 vets aren't even aware that they have the benefit of a VA home loan, which is crazy to me. They should definitely know that. So one of our jobs is to educate active military and veterans so that they know that these things are available to them. So VA eligibility, what goes into eligibility? So the first thing that a veteran has to provide, or actually through our system, it automatically comes in. Once a application shows it's a veteran buyer, the system will automatically order their certificate of eligibility. That's the form that'll tell if they've used VA before, if they have eligibility available. So within a day or two of the application, I see it just pop over in my system saying, here's a certificate of eligibility. We look at it to make sure that they have eligibility. And I'm going to show you how they get eligibility in another screen, but this is nothing you need to know about. It's just something that we have to be able to do a VA loan. So what
have to be sent with the offer?
No, that part not necessarily. I've never seen them ask for that. If the certificate of eligibility needs to be sent with an offer. No, usually I've not seen any agent ask me for it. There might be a seller who says, hey, how do I know they're a veteran or whatever, but haven't had that ever come up. So
it's more for the underwriter than it is for
it's just to show if they've got eligibility or not. Yeah, because if a veteran was discharged dishonorably, let's say, they wouldn't have this benefit. I'm going to get to a screen that'll show you how long they had to serve to be able to actually be eligible for the VA loan in a minute or two. So what are the advantages of a VA loan to a veteran buyer? One, it's zero down payment. So they do not have to put any down payment. They can, of course, if you ended up having an appraisal shortage, let's say, where it's selling for $1 million and appraised at 980, they could bring in the 20,000 to make it, not zero anymore, but they're covering something. But that's where the VA mandatory clause will come in, and I'll talk about that later. No private mortgage insurance with a zero down. So any conventional low down payment loan, any FHA loan, you're going to have private mortgage insurance or MMI for FHA, mortgage insurance premium. There's no income caps on a VA loan. So if they make too much money, there's none of that. No minimum FICO score. You may not get an approval with a really low FICO score because it still goes through automated underwriting, but there's no minimum required FICO score. Now, I know there's a difference between having no FICO score and getting an offer accepted by a seller, of course, because the seller typically wants to see that whoever's making an offer has decent credit and they're less concerned about that offer as a result. And the VA loan is reusable. Should they have a property now with a VA loan They sell that property, their entitlement gets freed up again. Even if they kept that loan, they still might have partial entitlement and still be able to do something with VA. But typically, if they sell their home, they had a VA loan on it, that VA loan gets paid off, their full eligibility comes up again. So VA loan options is what we'll cover. Let's see. It seems like it's skipping
Do you
slides
think
here.
they can buy investment property if they're still living?
Investment property, no. That is one factor that VA loans are only for owner occupied. They can be units, but they have to live in one of the units as long as the VA loan is there. So it seems like this
When they send the
format.
offer, what about deposit? What would the offer? Initial deposit.
Well, I'm guessing they still need to put a deposit to get their offer accepted. They can get all that money back at closing if it's not needed, but your sellers are going to want to earnest money deposit, I'm pretty sure, in most cases. Okay, so let me just see if this changes anything. It's skipping slides, so. Okay, I think this is going to be better. Okay. Sorry about the technical difficulty.
But when you get 20 years, well, we get 30 years. So there's another lesson. 10 years left.
They are 30-year loans. Yes.
Son got a 20-year.
Okay, yeah, there you can get whatever term up to 30, 15, 20-year loan, 30. Typically we're offering a 30, but if for some reason someone felt I want to pay it off sooner, or they're comfortable with the little higher payment, because of course the shorter the term, the higher the payment. That would be the only reason I would think that they would go with something else. But let's see. Okay.
So the offer is like a regular loan.
You
Okay,
make the
regular offer.
regular offer.
Funds and all of that.
Yes, yes. You may not need a lot of funds because of the zero down. They still have prepaids and other closing costs that they'll have to pay. So that's what you're wanting to see probably, is enough funds to at least cover those sort of things with the offer. But the down payment is usually the largest item on any offer. So with a VA loan, you do not have that. So just keep that in mind. So 100% financing is available. We can do loans up to $2 million. So it's not just for low down payment scenarios. We can definitely go up to as much as 2 million. I'm sorry, it's just I cannot see this easily. Okay, so we kind of covered this. They have very competitive rates, no monthly mortgage insurance required, and they even offer 100% cash out should a veteran want to do a refi later and pull out cash. So keep that in mind. So who can use a VA loan? Veteran, of course. Veteran and their spouse. Those two we can qualify with both the income. A veteran and another veteran, they can buy together and use each a portion of their entitlement. We also can have a scenario where a veteran plus a non-veteran can buy using a VA loan. Now that's where it won't be zero down any longer. If there's a non-veteran buying along with a vet, you're going to have some kind of down payment percentage. It's a very complicated calculation, but if it's one veteran, one non-veteran, you're putting about 12.5% down. If it's two other non-veterans, it jumps to somewhere in the 16% down range. And I think three other non-vets plus a vet, it's getting close to 20% down at that point. So it kind of takes away the biggest benefit of doing a VA loan, which is no down payment if you have non-veterans buying. Oh, and also a spouse of a veteran who has died of service-related disability. So they couldn't have just died of a heart attack or cancer or something else unless it was related to them being in the service. If it is, then their surviving spouse can use the VA entitlement as well. I haven't run across many of those, but I did have one transaction many years ago where unfortunately the husband had died. Not in the service, but after as a result of service-related situation. So that is allowed. Whoops. So here's where we talk about what you were asking me earlier in regard to how long do they have to be in the service. So if they're active duty, like they're in combat or they're, someplace in a war situation, they only need to be in for 90 days. If it's during non-war time, then you're going to need a minimum of 2 years in the service. 2 years, yeah. Let's say they served in, what's that?
It says here in your slide it's under 81 peacetime service. What is that, day or month or week? What is 181?
181 days.
That next one.
Yeah. So you're right. Just 1 day over 6 months. National Guard members, like people who didn't actually serve but were in the National Guard or reservists, 6 years. The surviving spouses, we talked about that already. And veterans who served less than the required term but were discharged due to a service-connected disability. So if they got hurt and they weren't in enough days, they will still qualify. These transactions do have to be owner-occupied and at minimum your primary residence for a year. So just like government loans, all deeds of trust, whether it's conventional loan, government, any of them will tell you, you got to live in here for 12 months, you're taking out owner-occupied terms. Non-owner investment property terms are different, bigger down payment, higher rate. So they want to make sure someone's not taking advantage of the system and doing that. Okay, let me go on. We already saw this screen about eligibility. It was skipping screens earlier, so now it's working. What kind of property types? So, of course, 1 to 4 owner-occupied, at least 1 unit homes. So it could have 3 units. They will not count rental income to help you qualify unless the veteran has previous landlord experience, though. They want to see that they've had a 2-year experience being a landlord in order to help them qualify at least. Doesn't mean they can't buy it. If their income is sufficient to do it, you're okay. You can buy a condo, of course. Has to be a VA approved condo, but definitely allowed. Oops. Sorry. New construction, that's also allowed. But primarily just straight residential, 1 to 4 or a condo is typically what we're doing. So advantages of a VA loan, we'll kind of talk about that. I think I started that earlier. 0 down, no income caps, lower FICO scores. We can go pretty low on the FICO score, but again, you may not have a seller who will like your lower FICO score. So 100% down payment is available unless you have those situations where you have the non-veteran buyer buying with them, or they've already used some of their entitlement in the past. Just trying to see if I can get this any bigger. I guess not. Okay. Sorry, I left my glasses in the car. I have trouble seeing some of it. Oh, yeah, I could do that. Oh, thanks. That'll work. That'll work. Thank you. That happens when you're 60 now.
They were calling me my magic, Philip's the cat. My shirt.
So even if the loan is up to 2 million, no minimum FICO required, which seems pretty amazing. But I don't know if you'll get an automated approval without. It'd have to probably be a manual underwrite, so it'll have to be a very strong file otherwise. No prepayment penalty is ever charged, so if they want to pay off the whole loan in 6 months, they can certainly do that. They can refinance quickly and easily. There's streamlined refinances for people, which are called interest rate reduction refinance loans. Cash out is available, and again, up to 100% for cash out as well. So what are the VA loan options? What type of programs are available to a veteran? And this is what we spoke about just a little while ago. The Catherine's son got a 20-year, I believe. But you have 30, 20, and 15 are the primary terms. There's a really great 5-year ARM too that's pricing, oh my gosh, it's like 5.625 right now, which compared to, you know, something in the 6s is not bad. And you know, for 5 years, you're going to have that. And we should certainly be lower in rate in the next 5 years, but I have been saying that for the last 4 with no reduction in rates over the last 4 years.
The regular 30 years compared to the regular loan, how much different is it?
Usually, VA and FHA are a little bit lower than conventional pricing most of the time, by probably 0.25%, somewhere around there. So rates are very good. They want to help them to be able to buy, so having a lower rate certainly helps that. You can do temporary buy downs as well. Though someone has to pay for it, you know, 1%, it'd be about 0.75% to buy it down, 1% for the year. Oh yeah, exactly. I think what more people might do is pay a couple points and buy a rate down permanently if they were getting help or other things. Concessions on a VA are very different than regular loan too. Any of the points and other lender fees are not part of the concession total. You can get up to 4% that can go towards your prepaids. You can even contribute money towards paying off a veteran's debts if you so wanted to, which is the only program I think that you can do that on.
So you get like $1 million, you can ask 4% salary to pay for anything.
For pretty much anything. For pretty much anything, you can pay their debts. I'm sure there's things that you can't pay, but things related to the transaction, yes, and some debts if that needed to be done. That's allowed. So I guess someone who really wants to help a vet, the people that I see accept VA loans the most and really want to help a lot are other veterans usually. They seem to really be
Buddy.
yes, yeah, there's a whole camaraderie, a family unit there. So VA loans, instead of PMI, they have something called a funding fee, and you'll see the amounts up here. So a VA funding fee, we just use abbreviation VAFF, VA funding fee. And you'll see that if they go 0 down and they're using it for the very first time, it's equal to 2.15% of that price or loan amount. If they're using it a subsequent time, like they already used VA in the past, now they're using the VA loan again, it's actually more, it's 3.3%. But it's not out of pocket. As long as this is under the VA loan limits for the county that you're buying in, you can roll that in. So you're not coming out of pocket. They're trying to keep the money out of pocket expense for a veteran very low. So
Wait, that,
yeah, so you know how Fannie Mae has 832,750 for conforming and up to 1,249,125. They go by those same limits as what Fannie and Freddie go by. So other counties, for example, well, VA loan, not so much. When I talk about FHA after, you go to San Bernardino, you can't go above 690 and still do an FHA with minimum down payment. LA County is a high cost county, so we have two sets of limits, conforming and then high balance. The conforming is the 832,750. The high balance is up to 1,249,125. And we'll see that on some slides when I do the FHA one later. You see that as people put more of a down payment, like if they put 5 to 10% down, that VA funding fee goes down. It's only 1.5%. Then even the subsequent use is 1.5%. If they put more than 10% down, it drops to 1.25%. But that's kind of how the government secures these loans and makes sure that if they go under default, there's something that's going to take care of getting that paid back. Cash out on a refi too, there is a funding fee. If it's cash out, it's 2.15. If it's interest rate reduction where no cash is coming out, it's only 0.5%, 0.5. So what are some of the steps to successfully closing a VA loan? So first we want to get them in touch with a lender who figures out what their purchasing power is. That's my job, to figure out what can they do. What is their required down payment? Have they used it before? Do we have full entitlement? Their DD-214, you might hear that term come up. That's their military discharge sheet that all veterans are told, hold on to this, make a bunch of copies, keep it somewhere safe. That's what told you how many days they served, what was their position, were they honorably discharged or not. And usually that and the certificate of eligibility are the two documents that we need to be able to do the VA loan. Of course, we're going to ask for W-2s for 2 years. We're going to ask for pay stubs for the most recent 30 days, bank statements for any money that's needed for any closing costs that they're paying themselves. If there's a divorce, we will ask for a divorce decree to make sure they're not paying alimony or child support or that sort of thing. Once they know totally what they're qualified for, then we need them be put in touch with a real estate agent. Usually works the other way. You've already talked to them. Now the lender's just helping you figure out what they can do. And then the lender will oh my gosh, hard to see. So you're going to put in an offer based on what our terms are. Yes, Catherine.
Say this, that DD-214, it gives them the amount that they can actually go up to buy property, how much?
No, the DD-214 just establishes whether or not they're allowed to even get the certificate of eligibility. It says that they were honorably discharged, they served for this many days, so we can match it up with the active duty or peacetime or wartime days. And that's mainly the purpose. But usually I don't need the DD-214 because if they get the certificate of eligibility, which the system automatically orders, it is presupposing that they had their DD-214, or the system would not kick that out for us. So after we've structured the loan, then we're going to come back to you and say, okay, this is what we've got. They can buy up to this amount. They have this much extra money in case you have an appraisal gap. Because even though there's this mandatory clause that we'll talk about, they can still buy it, but they also have an out to not buy it if they don't want to. So we'll go over that towards the end here. So we, at the point of getting everything figured out. We typically will submit the whole file to corporate underwriting because I'd rather have an answer coming directly from the person who's going to approve the loan than even just myself. I've been doing this for 36 years, but I'm still not the underwriter. We want an underwriter to look at the file whenever possible because they're going to give you all the conditions. If you do that up front, you can cut your escrow time in half. I just closed last week a $1,045,000 VA loan. Such a great deal this client got. The agent did a great job for them. It was zero down, $1,045,000. Their total closing, including prepaids and collecting 6 months of taxes, insurance, all that, it was something like $20,000. But they got a credit for $9,000. So on a $1 million property, these clients got in with less than $10,000 out of pocket. That was it. And they own a $1,045,000 property in West Covina. Beautiful, beautiful home. So those are some of the things that you make that happen for a veteran. I guarantee you they're recommending every family member and every veteran that they know to come to you. So keep in mind, they're a great source.
Just 1 year, right?
Just 1 year. Yeah, just have to, you can sell it. You can even sell it before that, but you just can't move out of it for the first 12 months. They want to see that you're buying this as a primary residence. Terms on all primary residences, whether it's conventional, VA, or FHA.
Like they can sell, but they still live there, like leasing it.
No, I'm just talking about they could sell the home in less than a year. That's fine. They just have to live in it as a primary residence.
Your home.
Yeah, yeah. So before you move out to another place, like let's say they bought a house, but then they weren't crazy about it. They'd have to wait 12 months before they could move to another one. They have to stay in that for 12 months.
That's the rule.
Yeah, yeah. But if they sell it in 6 months, they can move and use the VA on a new one. So, but all transactions, when you sign the deed of trust, whether it's conventional or VA, it says, I plan to live there for a year. After that, you could turn it into a rental with any loan program. Doesn't matter whether it's VA or FHA. Then once you have your loan approval, then you're calling the movers, hopefully shortly thereafter, and moving.
So they can replace it within 12 months, or otherwise they have to be in possession, for 12.
Just an occupancy requirement. So if they plan to move somewhere else, they either have to sell that, or before they can move out and keep that same VA loan, they're supposed to be there for 12 months. Conventional as well. If you sign a deed, you're saying, hey, I'm getting owner occupied terms, I'm going to live there for a year.
It's the same as the FHA ruling.
FHA, conventional, VA. Every owner occupied has that same, just 12-month requirement at least. So what does rate offer? We've got really good technology. So like I said, that certificate of eligibility is ordered immediately. Our systems will always, as a client, now that so much is digital now, as documents get uploaded into the system, it automatically underwrites it electronically. So if they uploaded W-2s, pay stubs, and either linked their bank accounts or they uploaded 2 months of bank statements with all pages, the system will try and approve it. So yeah, immediately. So we have that kind of technology. I didn't have that anywhere else I worked where it's that automatic. And then if you upload something new, it re-underwrites it again for what you've added to it to see, did that better the situation? You don't want to put stuff that would make it worse, of course. So if the system says, hey, I like the income, I like the assets, don't ask for anything else. It's in there already, good to go.
How about their debt income ratio? Same with conventional loan?
No, that's a great question, and it's not covered in these slides, so I'll touch on that right now. Debt to income ratio is one of the highest in the industry. That veteran buyer I just closed for $1,045,000, he was at over 55, 56% back end ratio. Yeah, you cannot go above 50% on conventional. Yeah, 49.9 is usually where you're maxed out. So a veteran, it won't be the veteran that has the 580 credit score. They won't get approved to that kind of debt ratio because all that's factored in. It looks at overall risk. So if you got a high credit score borrower, even if it's 0 down, you can get a really high debt ratio approved. So keep that in mind, much higher, up to 55, 56%, even some going higher than that. So you won't see any other loan program that'll do that. FHA comes close. FHA will do a 55% back end ratio, but the front end ratio, which is called the housing expense ratio, total PITI divided by gross income, on FHA, that's 46.99%. Yeah, you can't go above 47. At 47, it's going to decline. At 46.99, it'll approve if it's a strong file. VA, that front end ratio could be 52 and the back end total debt ratio, including all their other debt, at 56 and still get approved. So, and that's with, again, really high loan amounts. It can go to $2 million on a VA loan with 0 down. So it's not just for your low income borrower. So really, really good stuff. The rank of the service? No, not at all. Just as long as they have eligibility. Same for a admiral, a sergeant, whoever. Yeah, no difference there. Oh, and just back to the technology. So we can close really fast. That loan we were ready to close because they got pre-approved first. In the first couple days, we were just waiting for the appraisal to come back and prelim. Once we got that, we could have closed in 10 days or 12 days. The escrow was longer, so they still went the full amount. But if both sides said, hey, we're ready to close, we could have closed it sooner. So it's nice to have that kind of technology. Yes.
VA is really easy because with the DD-214 and all that stuff, it makes it run smoothly.
Yes.
Because that's telling about them and their background and all that. But the thing about it is, for us, the hard thing, getting connected to a company that deal with the service, that we could probably get in. That's the part that they don't.
Yes. Yeah.
You don't run into veterans like that. You see?
No, we're not like in an example. Let's say if you were an office that was near Camp Pendleton or near a military base, those guys do a lot of veteran deals because they're in an area. So you almost have to either look for clubs or organizations that serve veterans and try and maybe see how you can get in, like a VFW or a Legion Hall, some of those places. But otherwise, you've got to ask a veteran probably. Like maybe your son knows some organizations or something where you could get in there, and I'd be happy to go with you and do a presentation where I talk about the VA loan. All we need is an in, someone who could get us in. Most are, yeah. A lot of vets are all over the country, wherever they were stationed, wherever they met their wives or whatever the case.
When you took the class for the military certification, they tell you they're near the camp, you know. But what they also recommend, and what I've seen, if you go to the laundromats, because if they don't have a house yet, they're washing at the laundromat.
Wow. Well, I will tell you that Sylvia is so good at talking to people wherever she's at. We've gotten clients where she's been in line at a supermarket or at CVS or whatever and just says, have you bought a house yet? Next thing you know, I'm talking to him. We're getting him in the escrow.
Time purchase or
No.
refi?
Refis also. Yeah. And they can use it again after they pay off their VA loan or they still have partial entitlement. They can use it again in future.
They get a lot of benefits, I can tell you.
Oh yeah. The benefits are really good. And well deserved. You know, they risk their lives for sometimes for the whole term they're in there. So but the digital mortgage process that we have is just really excellent, smooth, and whether it's a VA loan or regular, it'll go fast as a result of that. So much of it is automated now. Okay. So again, our competitive advantages, we're fast, in-house underwriting. We have things at our company where like every day at 10:30 to 11, they have coffee with credit where if I got a question for an underwriter, I can go and ask them.
Good question.
Yes.
Being a Calvet, you can buy Calvet, right, and veterans twice.
Yeah, they're two
Okay.
entirely different things. So you could use a Calvet loan. We don't do Calvet, unfortunately. We only do VA. And I think you have to go to Calvet directly. There's some kind of organization that handles that. And it's a little bit different. From what I understand, it's more of a land contract type deal. So not where you have a deed right away. It's like you got to make payments, pay it off, and then you actually become the owner. So I think that's why standard lenders don't offer it. It probably has to go directly through Calvet.
Yeah, what is a VA no-no?
VA no-no is just a term where a veteran's getting in with no money down and no closing costs, meaning either, yeah, VA no-no. Yeah, yeah. I used to hear that term a lot before. Yeah. So if the seller were paying all the closing costs, or like us, we have no lender fees, so at least they eliminate that part. But let's say points were being paid, prepaids for tax insurance were set up. No down payment, no cost. That's a VA no-no. Great question. Great question. Yeah. It's probably not the term we want to use because it sounds like, oh no, VA no. Whoops.
So what's the catch with VA compared to regular loan? Nothing, right?
Really nothing. The only thing is I have seen, so veterans, there's a wide spectrum of veterans, of course, just like every other human being. Some have great credit, some have some bad credit, and sometimes it's a result of being in the service, moving all the time, mail going here and not getting transferred there. So if they had lates that messed up a lot of their credit, it could be tougher for them to get a VA loan, even though it's available to them. If the credit's like they have a couple of 60 and 90-day lates on their credit over the last 12 months, you're going to have a tough time getting a VA loan. Oh, yes. Yeah. Sometimes they might be the greatest person in the world, but if their credit is really bad, can't help them with a VA or conventional in some cases. So what's the VA amendatory clause? That was one of the main things Michelle wanted me to cover. So every time you do a VA deal, there's an additional form that you're going to need in there. I think it's a CAR form actually, and FHA as well. And they both say escape clause or FHA or VA amendatory clause. So this allows the veteran, or when we do the FHA, an FHA borrower, if it doesn't appraise at contract price, they can back out without any loss of earnest money deposit, even if they had waived loan contingent or appraisal contingency. So it overrides the appraisal contingency because it's a government requirement. They don't want the veteran necessarily paying overprice. So they have that out.
That's the catch.
So that's the one catch, probably the one thing where if you're a seller, you're representing your seller, you're a listing agent, you then want to make sure that there's an agreement or something with the other agent that, hey, if it doesn't appraise, does your borrower have enough money to come up with the difference? Because they're allowed to, but they just don't have to. So they could say, yeah, I'm walking. And then your seller's out of luck. So that's probably the one negative thing that you have to think about as a listing agent. Used to be people would say, oh, well, we don't want my seller to take a VA deal because they got to pay all this cost for the veteran. No longer the case. And even more so with us because of the waiver of the lender fees. So that would probably be the one thing I would think that could be slight negative on it. But again, this veteran that I did the $1,045,000, it was listed at $999. So they already went in offering $145,000. We were like, oh shoot, is it going to appraise for $1,045,000? Luckily it did. No work requirements, nothing. So that was a great thing. But had it come short, they were willing to come in with the difference. Of course, they didn't want to. They got in with $9,000 after all was said and done. But they had 60,000 in the bank should they need to bridge the difference.
So
So
even the appraisal, they don't need to pay.
no, the appraisal fee, they do pay the appraisal fee.
Oh,
That
they
is a fee that the veteran did pay and is allowable fee. The only things that are not allowable truly are if all of the lender fees, like underwriting, processing, whatever the lender fees are, if they exceed, and escrow fee as well. So keep in mind that is another thing. The seller, usually it's half and half, right? One side's paying their buyer's escrow fee, seller's paying their half of the escrow fee. On a VA deal, certain fees like that are not allowable. But if they're under 1% of the total price, which with prices around here, you're not going to have a problem with that usually. So if your property's 800,000, you can have $8,000 going towards things like escrow and non-allowable fees. Just once it goes above that, then they're asking the seller to pay. So that's where the non-allowable situation could be more of an issue for your sellers. For a buyer, I don't think any of it's ever an issue. They're getting a great deal. You know, it's more so if you're listing agent,
So they're not waiving the fee, you're just having the seller pay the fee.
either that or if it's under 1%, the veteran's able to pay it.
Oh, okay.
If 1% of the total, then they can pay those things. So usually we're okay around here with that. But in the past, that would be probably the main thing that I would hear why sellers didn't want to take a veteran.
Okay, is it gonna be added on the low or is it like?
No, it's just a cap. They can't. So as long as all those fees that the veteran is not supposed to be paying because they're not allowable are under 1% of the price, they can pay them. The veteran. So he can pay those fees, but once it goes above 1%, then usually there's concession. Escrow fees is usually never going to be 1% of the sale price. It's going to be a few $1,000s, but it's not going to be $8,000 in most cases. So
So it's limited to 1% then, not higher. That's the trick, right?
yeah, non-allowables, as long as it's all under 1%, the veteran can pay them. It's just once it goes above that, then
Used to pay for the buyer's agent commission?
commission's not counted in that. They can pay commission. The veteran can. Or the selling side pays it, which I think still seems to be on every deal I've done.
Buyers or the seller's agent that they don't pay. I remember something, the listing or the buyer, one or the other, I remember that from the certification.
I don't think any longer then. Yeah. So, and especially with the change we had a couple years ago. I don't know, are you guys seeing many where the buyer's having to pay their? I haven't seen any loans that had it. Of course, it's allowed, but I think sellers realize that, hey, if we want people showing this listing, we got to pay something. So usually not an issue. No, absolutely. Some of the other things just that are not in this presentation that you want to be aware of are condition of the property. That's another thing that people ask about. So if the property has a ton of deferred issues or health, safety, and security issues, this is kind of similar on FHA as well. Those may need to be addressed. There's funny things too, like I know that if water is, like if the grading away from the property is coming this way to the property where water's going to sit at the edge of the foundation, they'll make you grade that so that it's moving away from the property. I actually, about 20 years ago, here in Alhambra, did a VA loan for someone, and that was on the appraisal report. And I'm like, oh my gosh, went out there with the client and helped them with a hoe and shovel and did that extra work to make sure we cleared that. But on any VA loans I've seen recently, I haven't seen them calling out anything. Of course, if there's health and safety hazard, like if you got security bars and there's no release, that's a problem. You're going to have to take off the security bars.
Follow the FHA rules?
Say again?
You said in condo, they have to follow the FHA rule?
No, they just have to be a VA approved condo project to be able to do a VA. So that is where you may not be able to finance VA if the project is not VA approved.
What is their requirement? Like
Same.
owner occupied?
Usually they're going to want to see things like a predominance of owner occupied units. Now more than 25% of
Same.
homeowners delinquent on their HOA dues more than 60 days. No
Yeah.
pending litigation that could affect all the owners because there's a $50,000 or $100,000 lawsuit filed, that sort of thing. So even conventional has that. Even though you don't see it much, we're getting a questionnaire filled out called an HOA questionnaire at the very beginning that asks all those questions. And that's where we find out if the condo project's going to be a problem or not. So that is one thing you do. Like if you have a veteran buyer and you're looking at condos, just call me and I'll look up the condos for you and see if they're on the list or not. That way you're not wasting time with that loan, that property if you can't go that route. No. And I think I'm way over on time because we had a little technical difficulty to begin with. I do have another part of this that is FHA, but I'll need to check with Michelle real quick to get that up here. So maybe take a 2-minute break and I'll check in with her.
Yeah.
And then if you have any questions in the meantime, just ask away. But do some VA deals. They're great for the veterans. They're very easy to get them in. They're zero down, higher debt ratios. Same commission as you make on anything else. So when you have them, just call me and I can walk you through it. You don't have to remember any of this, but you can reference back to this PowerPoint. And then for the details, call me and I can walk you through it. These 2 flyers went with the VA and they're on your desk as well. The 1640 lender fees are waived. So and this was printed in 2018. We had saved $65 million for veterans by paying those 1640 in fees.
So they wait?
We waive 1640 in lender fees. On every veteran deal, they don't pay them. Those are the same fees you pay on a conventional, but on a VA loan, no.
On a VA, no.
VA loans,
What is the
we
equity?
basically waive them for them.
Chris,
Yeah.
what is the interest rate right now?
Depends on if it's high balance or conforming. High balance, which is up in that above 832 range for LA County. Those I've been seeing about 6.6, somewhere in that range. But I've actually seen the high balance for whatever reason be a little bit better than that, maybe an eighth or a quarter better than that. And a 5-year fix, a fix for 5 years, then becomes a 1-year adjustable after. So not for everybody, but a good one for someone who either knows they're going to move in less than 5 years, or they think that, rates are coming down somewhere between now and 5 years. They're at 5.625 with 0 points right now with us.
5.625.
625
For the arm,
Is
right?
that
For the arm.
for a 5-1 arm.
FHA?
That's just VA. I haven't checked FHA. FHA is not as good for sure. VA has some pretty good pricing right now.
You want me to go get Michelle?
Oh, maybe, yeah, if you could, that would be great.
I got it.
We'll be right back with you in just a moment.
Question on that.
Yes.
You say after the 1 year owner occupied, and you say they move. Of course, sometimes they have to move to work a job, they have to move out, and that property stays vacant as like owner occupied, right?
They can rent it out, do whatever they want after 12 months.
Really?
Yeah.
Eventually.
Yeah, their entitlement will stay there, so it'll be tied up. They can't go and get another VA loan because it's tied up in that. So unless they refinanced out of it, yes.
Investment property or vacation home.
Yeah,
That's
and
what
and
it
it can be turned into an investment property afterwards, but only if they want to be able to use their VA to buy another one in the meantime.
let me say that. You say,
The only 1 year thing is because it's owner occupied transaction. So whether it's conventional, FHA or VA, you're telling the lender, I plan to live there 1 year. After that, you can turn it into a rental.
but do I have to refi the loan?
Only if you want to buy another place and use your VA and go zero down. Yep, yep.
Okay, that's
Yeah.
fine, that's fine.
So what are we doing?
Oh, I'm just trying to find the second email I sent that
Okay.
has, that FHA presentation, that one. This one's a lot shorter, so I'll just fly through it. Yeah, for some reason it wasn't opening like a slideshow.
Is this it? This one, right?
No, wait. Yes.
讲的出来，他们的动机。
But maybe 4 years ago, it was when it came really.
I got mine this way. And then you present to.
Is it up?
No. Share. There you go.
Okay. All right, everybody, he's switching into FHA. This will be a faster block. Okay, thank you.
Thank you so much, Michelle.
Oh, thank you. I'm gonna go back and listen to this one. Now it's done? Yeah, he's got it up. Okay, yeah, I have the phone guy here too.
This is a lot shorter presentation. Okay, you guys can see that?
Yeah.
Okay, great.
This one.
So yeah, this is VA. I'll try and keep it at 15 minutes. We'll move quick. And if you got to go, you'll have it here at least. But so FHA, what is FHA? It's another government insured loan. I know predominance around here is always conventional financing, and I think some of it's just because people don't understand FHA, or what do I got to worry about with FHA? Are there things that are different? So we'll try and cover that. Okay, so we kind of covered this. I'll skip this. It just tells about our satisfaction rating and how we do. Okay, well, that formatting is not looking right, so I'll try and just go over with you. You'll see it better on your paper here. So these are the current loan limits for LA County. They're all different. You can just Google FHA loan limits and it'll pull up what you can go to. But it's not a first-time buyer program. A lot of people think FHA is a first-time buyer program. You have to be a first-time buyer. No, just have to own or occupy it for that same situation at least 1 year. And you can only have one FHA loan at a time, kind of like VA. You can only have one VA loan at a time, at least to use the full entitlement for VA. But FHA, the only time they'll allow you to have a second FHA loan is if you're moving more than 100 miles away from the first property, like your job moved you and now you got to go somewhere else. Then you could get a second FHA. Otherwise, you got to pay off the first one with a conventional refi or whatever before you could use an FHA again. But you'll see that 1 unit, the limit's 832,750, but high balance, which LA County has, that'll go to 1,249,125. You can buy a 1,000,003 property, probably use FHA. If the loan amount stays under 1,249, you can still get it. 2 unit goes to 1,066,250, high balance almost to 1.6. 3 unit, 1,288,800, and high balance up to almost 2 million, 1.9. And if it's a 4 unit property, the conforming 4 unit is 1,601,750, and you can do a high balance in LA County up to 2,402,625. So very high loan amounts. You can finance most properties with FHA if you wanted to. And why would someone go with FHA, usually it's because they don't have a ton of money for the down payment. You can go with as little as 3.5% down on a single family. On 2 units, they'll count the entire rent of the second unit, take 85% of that, and that'll help you to qualify. There's a different calculation if you're buying 4 units though, or 3 units. They want to see that the property debt services, and I won't go into that today, but if you ever run across that, call me and I can walk you through that. You can do condos with FHA. They do have to be also an FHA approved condo project, or they have to fit single unit availability. So we can do a single unit in a condo project if it meets certain criteria. So similar to conventional, they're going to want to see the HOAs in good standing, that there's predominance of owner occupancy, there's not too many delinquencies on HOA dues, there's not some crazy lawsuit against the HOA. So very similar, but you might be able to do a single unit even if that project is not FHA approved. And we have a whole condo department that handles approvals if you wanted to get the full project approved. There's fixed rate and ARM products, so whether you're doing a 30-year fixed, there's also 5-year fixed. At times there's just straight 1-year adjustables, but I haven't seen anyone use adjustables other than maybe a 5-year fixed these days. Again, why work with us? We kind of covered that in the first one, the digital mortgage, the quick approvals, getting a full pre-approval before you go out with your clients, things like that. And we do every kind of loan out there that's residential. We've got loans backed by crypto now even. Haven't done one of those, but we have it, where you don't have to liquidate your crypto. You can leave it there, but you know, crypto, I won't say much about crypto. I've made and lost money on crypto. Oh yeah. I had some crypto the other day that was up like $1,600, and blinked my eye and looked at another day and I was down to like $40. So don't mess with crypto unless you got extra money to throw around for sure. So FHA basics, it's almost the same as doing a low down payment conventional loan for all intents and purposes. It's just as easily approved. I think that people used to feel the same way, like, oh, they got to pay some fees if we're doing an FHA loan. Not the case at all anymore. When I started 36 years ago, yeah, there were some FHA fees that had to be paid by seller. That's not the case anymore. So as long as you have a property that's in good condition with a lot of health, safety, no health, safety, security issues, you should be fine. Chipping, peeling paint is one thing that FHA appraisers will call out that might not be a big deal. But anytime there's chipping, peeling paint, that leaves bare wood, which then could be termite issues. So just keep in mind. And lead-based paint. If it was built before 1978, they want it repainted with 2 coats of non-lead-based paint. Most houses at this point have been repainted, so you don't have that to be an issue. But chipping, peeling paint, they will call out. So even if there's termite work done, and you know how a lot of times the termite company leaves bare wood after they repair the wood part,
They'll call it out.
they will,
Because
at least it has to have primer on it. Just, they don't like bare wood. Even if it's on a shed in the back, they'll say either get rid of that shed or paint it real quick. So keep that in mind because of termites. In other states that don't have termites, not an issue, but here, Arizona, we're termite states for sure. So, oh, that's one thing that wasn't on the slideshow for the VA. You will always need a termite on VA. The veteran can pay for it now. They didn't used to be allowed to, but you will have a termite requirement, and veteran can pay it, but someone has to pay it. And if there's requirements like sections that need to be repaired or eradicated of termite, you're going to have to do that. So, but again, the veteran can pay for it. It's allowed to now. Same with FHA. With FHA, if there's no termite requirement in the contract, you don't have to worry about it.
Okay.
So sometimes people write it in and then later on, they're like, well, we'll remove that so there's not a problem with the loan or whatever. Because if you have it in the contract, you got to get the termite. And if there's work requirements, they're going to ask them to be done. Section 1 for sure. Section 2, it depends what it is. But Section 1 definitely. Let's see. %100% gift is allowed. So you can come in with none of your own money if you got a parent who's willing to help you with money. You don't have to have a minimum contribution from your own funds. High balance loans are available. Condo financing is available. That single unit situation is available. Higher debt ratios like we talked about here on this page, right around here. You'll see that we can go to 46.99 on the front end, 55.99 on the total debt ratio. Not all of them will get approved at that because we still run it through an automated underwriting system like Fannie Mae's DU, Desktop Underwriter, or Freddie Mac's Loan Prospector, LPA system. And you always need that if you're getting those higher debt ratios approved. They'll do a manual underwrite. So if your credit score is too low, they won't allow it to go through automated underwriting. Or you might get something that says refer, ineligible, or whatever, may not go through the system. Doesn't mean you still can't get that loan approved, but you have to actually have an underwriter to look at it. And they're not going to go as high on the debt ratios when it's a manual underwrite. If it's a system approved underwrite, that's when they go to the highest levels. So just keep that in mind. 203K loans are available. This is a renovation product, meaning you can get, like some listings will say, hey, no FHA, no conventional, we need cash because the kitchen's missing. The bathrooms were torn out because they were doing a remodel and ran out of money or whatever the case. You can't get any loan with those usually. FHA has a 203K and Fannie Mae and Freddie Mac have their own reno programs also. But now you can take the cost of that renovation, put it on top of the price, and we're going to base their 3.5% down on the full amount financed. Have to be contractors with good standing involved. They have to be a contractor's report drawn up ahead of the appraiser going out so he can incorporate all those things into the appraisal. And they do 2 values, an as-is value and an after-improved value. Yeah. And I've seen those transact. We had that one in Compton. Oh my gosh, this house looked like a U, but they had subdivided it, put in extra kitchens and bathrooms, which you couldn't have. And then it was in a high graffiti area and it got broken into 2 or 3 times during the escrow. And they had to repaint and do all this other stuff. But when he got done with that transaction, it went from 170,000 or something like that to 5 something in a matter of just a short amount of time because they did the renovation all in one loan. So they don't have to wait for equity to build to take out a second loan to do it. There's a 203H program for people who are in a disaster area. I haven't done one of those yet, but they are available as well.
What's that age for?
I think it's just 203 home, I think is that, but it's for disaster. Like people who lost their house in a fire.
Yeah.
FICO scores down to 580. Again,
Oh, yeah.
maybe your seller won't accept the 580, but it is allowable. Yeah.
One is gonna have that, 580, but then the rate will be a little bit higher.
Yes, rate will be a little bit higher on those 580 borrowers, but still they might be able to get in and then build equity and hopefully fix their issues with credit during that time.
Continue.
Yeah, so the 203K, we kind of touched on that already. There's 2 types. There is a streamlined 203K, meaning if the work is under 75,000, we can do a streamline. It only involves 2 draws, one at closing for half of the money and the other one when they complete the work. So you got to have a contractor that's willing to wait a little bit to get all their money. But you could take a partially burned down property, and if it can be rebuilt within the parameters of aftermarket value of the new, once they fix it, you can do that. So no longer does it now the seller saying, hey, we can't do this loan, or you can't come in with an FHA. You could, because we're going to do all this post-closing. We're going to close with that house being junk the way it is. and do the rehab afterwards. So keep that. If it's more than 75,000, it's a full-blown 203K loan. You can do those all the way up to the limits of the 1,249,000, whatever you're at, in whatever county. So keep that in mind. It's a great way to have a rough property, get financing, and the seller doesn't have to be concerned with it because it's going to close as is. We do all the stuff after. Yes, Virginia.
They purchase the property, they have to do loan.
Which part are you referring to? I'm sorry?
The 203, that is only for the loan for the relief loan, right? Disaster relief loan.
That's the 203H.
So that means only apply for that loan, one loan, only. It's not for.
Yeah, that one, the 203H, not for everybody. 203K, I'm sorry for all the letters and acronyms. The K one, you can do the rehab. It's one. It's just one single loan. Combine it all into one. Yeah, so let's say you bought for 500,000 and your rehab was 100,000. We're financing 600. Mm-hmm. PMI cost is, so there's 1 3/4 up front. So there's 2 PMIs on an FHA loan. Yeah. The upfront mortgage insurance premium is 1.75% of the base loan amount. So your price minus down payment, multiply that times 1.75. That gets rolled into the loan. So that one's not out of pocket. But then there is also a monthly amount equal to 0.55% of the loan amount. Mm-hmm.
Understand.
Just 0.55.
Oh, point, oh,
Mhm.
okay.
Yeah.
1.5 is the one you take for the.
That's the monthly one. Yeah.
Oh, okay.
It's very reasonable. It's much lower than a 3% down conventional PMI would cost. But you have the upfront one in addition. It just gets financed in. Yes. That one gets rolled into the loan amount.
Yeah.
So it's financed.
For the fee or what do
You call it the upfront mortgage insurance premium. Yeah.
This one is not, this is added to the mortgage.
Yeah, so it's not out of pocket. You're not coming out with additional money. You could. I've never once in 36 years seen a client go, I want to pay for that PMI out of my pocket. They're allowed to finance it, so
But the
why
upfront
not?
cost, how much?
The upfront one is 1.75% of your base loan. So price minus 3.5% down, that's called the base loan amount. That 1.75 gets added on top of that. So it's financed into the loan. And then the monthly part is calculated at 0.55%. So it's pretty reasonable.
It is.
It's relatively reasonable. And then if you're getting a lower interest rate also, it's not a bad combination to get in with a low down payment and have those features. Condos, again, if they're an FHA approved condo project, if you're working with an FHA buyer, just call me. I can look it up. You can even look it up. There's a sheet on here that shows you a link to it, but I could do it for you. And if it doesn't, you find that it's not FHA approved, doesn't mean we can't do it, but it's not automatic then. We do have to go through the process to do the single unit appraisal and see if we can do it that way. Sorry guys online. This is the condo slide. And I won't go into each of these bullet points, but take a look and call me if you have questions at all. But again, the big things are they want owner occupancy to be like 50% owner occupied. They don't want more than 35% of the overall condo project to be commercial use. So, you have a lot of mixed use. The bottom floor is businesses. That can't make up more than 35% of the overall units. Manufactured homes are not eligible for condo loans. So keep that in mind.
Wait a minute, can you say, tell her why? Tell us why?
On which,
You said manufactured homes are not with the condo loan.
yeah, so condo projects sometimes have manufactured homes in them. For whatever reason, FHA doesn't take on the risk for those. They just like conventional loans, we can't do most manufactured homes unless they're on their own piece of land. We could do a manufactured home that's a single family residence on its own piece of land using FHA all day long. It's just if it's a condo project that used manufactured homes in part of their condo project, for whatever reason, they don't allow. It's not a standard property type, I think, is the main reason. That's what I'm talking about mainly, yeah. But a mobile or manufactured home permanently affixed to a foundation built after 1978 on its own land, like out in the desert, there's a lot of them. Those you can do FHA on. Yeah. And all these, they just have to meet FHA's minimum property requirements, which again are primarily free of health, safety, security. So if you were to walk into a home you're looking at and you're trying to list this for your seller, if you see a flooring missing, like there's 6 tiles missing from the floor, not a big deal, but for FHA, they're like, well, someone could trip and get hurt on it. Carpet, same thing. If there's a big tear in the carpet and someone walks down, they're not looking, trips and breaks their head, that'd be an issue. Empty swimming pools are always an issue. Conventional, FHA, otherwise, they have to be filled. Even though someone could drown just as easy as maybe crack their head falling in, I guess there's more chance of dying from falling into an empty pool than one that has water. So keep that in mind. What else? Impounds are always required. So, whether they're putting 3.5% down, taxes and insurance and mortgage insurance. And the one probably negative, I'd say, of FHA loans is, and the reason that you eventually want to refinance to conventional is they have PMI for the lifetime. Unless you put more than 10% down, it will drop off in 11 years. But if you're doing 3.5% down, you've got PMI
For the lifetime?
for the lifetime.
Even if you find.
You gotta refinance.
But if you refinance.
If you refinance to conventional,
Then the life is gone.
yeah, usually once you get to 20%, you're going, I think I'm gonna look at that conventional loan now. Because you want to get rid of that.
Okay. For a lifetime, you mean you're even have to apply it and apply it and apply it.
Yeah, no. As long as you get out of the FHA and into a conventional eventually, that's when you'll get rid of the PMI. So you could go in with 50% down. So this is why you wouldn't go FHA, of course. If you had more than 20% down and you're going to have PMI anyway, even if it's only for 11 years, go conventional.
Yeah.
You don't want to, you want to pay for that. Yes.
Question. The FHA rate
Yeah.
is lower.
At
than
least
the
right now it
conventional-
is.
The convention.
Yes. And sometimes considerably lower. But there are times when I've seen in the past, because 36 years of doing this, I've seen times when FHA rates were higher, and I don't know what the correlation or the reason for that was. But probably in the last 10 to 20 years, whenever I checked FHA financing for a similar down payment, FHA is going to be a lower rate. And the PMI, once you put 5% down on conventional, and you have high credit scores, you could probably do better on the PMI with the convention. But if your credit scores are bad, like if you're under 700 on conventional, I guarantee you FHA is going to be a cheaper PMI premium because it's not different for different credit scores. Whether you have 620 or 780, the PMI is that same 0.55% calculation.
Because they're trying to incentivize first-time home buyers, obviously. That's my
It's a government insured loan, and the government knows that if you have more homeowners, they take better care of the property. There's pride of ownership. There's all kinds of things that come, as you guys know, as realtors, people owning homes. It's a big thing for not just that homeowner, for their community, for everything else. So the government likes to promote that. That's why they make the guidelines easier. So yeah, so lower rates, higher debt ratios. The housing expense still kind of go above a 46.9, which is the PITI divided by gross income. But the total debt ratio, including all their other debt, you could be 55%. That could be 100,000 more than a conventional borrower, possibly.
The 5%, sometimes they give you 5% and they say convention.
Yeah,
There's the homeowner, okay.
totally allowed. Yeah, you could do
But
3
it's still the PMI.
PMI. Yeah, you'll have PMI.
10% is still the PMI, even though it's conventional.
Yeah, the difference with conventional is the higher the score and the more you put down, the cheaper the PMI gets. Where FHA is a fixed amount of 0.55, whether it's 3.5% down or 10% down. Conventional, when you're putting 5% or more and you got a good credit score, you'll have a cheaper PMI on conventional.
Less restriction.
And less restriction. Yeah.
FHA loan is owner occupied only,
Yes.
you can rent out.
So it's so again, many people think, hold on. Many people think FHA is a first time buyer program. No.
Yeah, they believe that.
Yeah, they used to think, oh, I got to be a first time buyer. Nope, but you got to occupy it. Yeah, a minimum of at least 12 months. So I'll just leave it open to questions if any, because I'm way over time here. I probably went 35 minutes over. Michelle's going to kill me, but yes.
See, what kind of programs do you have? Like civic loan?
Oh yeah.
Down payment or for the.
Down payment assist and all those different
Yes.
things. So I've done over the last 36 years a ton of Cal HFA product. Those are very easy. The Dream for All is the only one that's not easy because it shouldn't be called Dream for All, maybe Dream for a few, because it seems like I've put in, on the last go round, I had over 20 pre-approved clients that I got ready for that program. You know how many got a reservation? 0. Oh, one did, but they were the one borrower who can't buy a $200,000 home in California, and that's what they were qualified for. So, but I have closed 6 of them. So when they worked, and those people got a large assistance up to 150,000. The first time around, it was 20%. Didn't have a cap. Some got 200,000. Did $1 million property, got 200,000 on that Dream for All. So we do a lot of that. Golden State Finance Authority, also another down payment assistance program, do a lot of that. That'll do 1 to 4 units, FHA or conventional. The difference is the assistance is in the form of a second that you have a payment for. Cal HFA, it's a silent second, meaning no monthly payment for the part they lend you to cover the down.
And you mix them?
Some of them you can, but Cal HFA and GSFA, they don't allow you to mix them together. Sometimes you can get like the mix of one of the state agency funds with a Cal HFA or GSFA, but the problem is they all want to be in the better position. So you have to find one that would subordinate or go third position behind Cal HFA, because Cal HFA says we're going to be in first and second and third if they're doing a third, because you can get a couple loans there. But beyond that, if the other lender's willing to go into the subordinate position, you could do it. But otherwise, no, that's where they fight.
You can get more than one.
Yeah, often you can. It's just a matter of,
Before you could only do one.
yeah, it's really layered now. You can do a lot of layering. Those are nightmarish deals, I mean, for a lender to put together, but once you do them, oh, believe me, those clients, first time buyers send you more referrals than any other client, in my opinion, just because they thought they couldn't even get in.
Oh. Thinking about working with first time home buyers, he's the one to work with.
Oh,
Because
yeah.
all of them are not
Oh,
gonna
yeah.
give you more than one loan. Even if they know they can, some of them just too lazy to even do it.
I'll tell you, that's the thing I find most. Almost all the lenders out there can offer you Cal HFA and Golden State Authority, but they don't want
You
to.
know what?
And one
I-
thing I can tell you about Chris, he works with you and he's explained, all the clients have told me this. He explains everything to the detail,
That's good, that's
to
good,
the
because,
detail.
because like I just
Yeah.
said, I went to a home buying, seminar, I think it was last month. And, that's when I found out that you can, we call
Layer them.
bridge it.
Yeah.
And, because before, you could only do one,
Mhm.
Yeah.
and they said, no, you can bridge it. But when you find those type of people that know what they're talking about and they're presenting that to you, those are the ones you work with. You don't run over here to tell them, because they're not gonna do it.
Right.
Yeah, some of them have them on, available on their roster products, but they've never done one, and that'll be a nightmare. We just got recently a new zero down program that if the buyers are buying in an area that's more than 50% minority or under 80% of area median income, the area, they could make more, but if the area, it's a community program. Those are usually only available through banks, and this is through a bank, but we're able to offer it. So it's zero down, no PMI. So that's just like a VA deal practically. But I did see the fees and the rates were a little higher. That's one thing you'll find on a lot of the down payment assistance products is because lenders don't like to do them and they're way harder and they're less profitable, they do charge higher origination cost on them. So, but it's still, most of that ends up being financed through the loan with some kind of assistance. So it's a trade-off, but definitely a good one. Thank you guys so much. I went way over. I hope you learned some things. Oh yeah, I hope you enjoyed the food. Whatever's there, take whatever you want.
Can you tell he's a savvy lender?
Yeah.
No, he's both very, he's very calm.
Yeah. It's very good.
I was having much technical difficulty today. It wasn't the usual PowerPoint. I'll give that to you. Thank you, everybody. Thank you guys for staying on so long. Appreciate it.
Because we have a chance to ask all the questions. Now I know every day you check if anybody has some chat with you.
I should check that. Yeah, let me see.
Let me tell Michelle the.
Thank you.
You're very welcome. I think they tried to call me right in the middle of this.
I know.
I saw that.
Yeah, because I told them, and Eduardo said that he called you yesterday. Let me see.
I'm not sure where to look for questions on here.
I don't know. They have questions.
Oh, just seeing if anyone had questions. If you do have questions, my contact information is there. Reach out to me and I'll be happy to answer them directly to you. Thank you so much again for letting me speak and for being part of this. Thank you.
Pablo called, he said that he called you.
Yeah.
And I just saw a missed call right. Hey,
Thank you, Chris.
Pablo. Thank you.
thank you.
Please do it, huh?
Oh, yeah, we'll get them figured out.
Anita.
Come and visit.
¿Y qué se fue?
Do you have one of your business cards?
Oh, yeah. Give me,
Yeah, I'll give you a few.
yeah, please.
Sí.
Mine.
Yeah, you those out. Happy to.
Okay, record.
Yes.
I think I already have. I have your original.
Oh, you from the other company, probably?
Yeah, another company.
Thank you, Kevin.
Start with a G mortgage.
Gem Mortgage or
Yeah.
Gem Mortgage. I had a branch of
Gem
Gem
Mortgage.
Mortgage up here for 18 years
Gem mortgage.
on the corner of Chapel.
Yeah.
Yeah,
Yeah, the
yeah.
company.
Oh, nice, nice.
Because you
Yeah, of course.
That's well.
Thank you so much, Chris.
Do you have one as well? Can I get from you?
Let me try the.
It's, I'll come over there.
You can have your own ready, right? The new one or not? Not that much.
This is better.
I don't have that.
Give me one more.
It's in my little wallet.
Yeah, just one. Oh, awesome. Perfect, perfect.
Right.
I've given you.
Thank you, Sylvia.
You think it- I love it. I sent, Jair and all of them, send them an email, I have his contact too.
I still have one.